Welcome to the second hour of TheoTrade. I am Professor Jeffrey Bierman. I'm broadcasting you live from Chicago. And today is Monday. It is September 22nd. It's 2025. And this is midterm week for me, people. I got problems with you people. It's midterm week. I'm actually giving a midterm on Friday. This will be the last day of instruction. I have a review on Wednesday. So I've got to kick in gear with Loyola today. But that doesn't mean I lose focus in the market because I track it all the time. I live and die by it. So let me say hello to the usual people. Hello, Guatemala. Guatemala, I didn't see your doppelganger there today at the gym. Chip, Peter Schrader, good morning. Trains, Ron K, Tim, Ship, Bart F, Rogue Bro, Ed Mines, hello, Kevin Press, Miguel. Good morning. It depends upon the side of the market you're on, but, you know, my shorts, they just keep, like, you know, building up my wealth here. There's a way to short this market, and if you're short today, you don't understand. That's why I want you to convert to the Genesis call, because I will teach you how to short markets. If you keep short in this market, you're going to run into a lot of problems, people. I'm not short this market. I'm not, so I'm not feeling any pain here. I'm going to do a trend session today. I'm going to hold off on the slide. I will bring it up at the end of this, the top of the hour. It's a surprise. It's a trend. So if you go to my category, my archive, pardon me, there's 11 categories. You can whip through them. There's 4, 4, 4, and 3. There's trend, there's momentum, there's scanning, there's a support resistance, there's channeling, there's fundamentals. I got it all, people. I'm covered it. This one falls under trend. It's been months, and I mean over 3 months since I've done a trend, which is way too long. This has been sitting in the back burner. I'm bringing it out today. This one defends Blake Young and Brandon Chapman. Brandon Chapman comes out all the time and tells you about how gold and the market don't equate. I'm going to nail it for you. The guy's right, and I'll show you mathematically. Okay, because numbers don't lie, people do. In the meantime, let's talk about the market today. Now, I'm leaving this one wide open. There's a pun in this, but I don't think any of you are going to get the pun. It's double entendre. Double entendre is, you know, French for two meanings. Hello, Joyce. Joyce is out in Spain. Joyce was a student of mine at one point in my mentorship. Good student, too. Tis the season. Okay, so let me bring this to you. Listen up. What is tomorrow? What's tomorrow, everybody? What is it? It's Rosh Hashanah. Tomorrow is Rosh Hashanah. It starts actually at sundown tonight. Rosh Hashanah. So there's an old axiom full of crap, lies, 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 but the market seems to attach itself to it. It's called sell Rosh Hashanah, buy Yom Kippur. That was the old adage. Sell Rosh Hashanah, let 8 days go by for the holy market, and buy Yom Kippur, because the market would sell down from lack of traders. It would have given opportunity to buy on the dead cat bounce and then bring it back up. That's the axiom. Okay, why does that not work now? Why does it not work? Because there's no traders. It's run by machines. So the traders can go to Temple. Who the hell cares? They press a button and the machines will take over. You don't have to be at your chair anymore. You don't have to be sitting in Temple listening to your rabbi, hitting your Robinhood account. You don't. Just press a button and it's auto run on machines at prop desks. That's why it doesn't work anymore. Machines will take over. They'll do all the work. The second reason why this is called tis the season is because you're in the last lap. It's it, people. It's over. Friday. It's over. It's done. You're finished. Next Tuesday's the 30th. It's the end of the quarter. Open season for hunting wabbits like Elmer Fudd. They're going to whack the crap out of this thing, people. It ain't going up more than a couple of days before it comes down in October. Okay? You're on borrowed time. You're on borrowed time, but it's borrowed time attributed to the season. Season of window dressing, season of Yom Kippur, between Rosh Hashanah and Yom Kippur. And it's also the season where even if you're not at your desk, here's the thing. There's not a preponderance of selling pressure. Nobody wants to sell. The only thing they're selling is weakness. This is a bifurcation acceleration. They're just beating the crap out of the weak stocks. And what are they doing to the parabolics? They're chasing them. I'm frightened, FOMO, me buy Tesla. They're going nuts. They're buying all the 52-week highs. AppLovin, Tesla, Apple. They're just chasing. Your geniuses are just waiting strength and they're cutting down concentration on weakness. Congratulations. What does that have to do with fundamentals? Nothing. Nothing. So in the short term, it's tis the season. If you walked in today and shorted, I would have fired you at my firm. If you work for me, you'd be fired. You can't, you're shorting this? Really? You're going to, I told you there's a 0 probability we're going down. 0 between now and the end of the quarter. 0. If we drop 50, we're back up 50. The algos will buy it and bring it back up. It can't happen. The money managers are not going to let it happen. They're going to book these monster gains after what could have been a disastrous year because of the tariffs in April. You're not thinking. Stop with it. Your charts are useless. They don't mean anything right now. It's the season, people. You got to book those gains, chase alpha, get rid of the negative alpha, and hold it up here. So if you want to see what it looks like on my screen, I'll be happy to show you the Genesis cog. Powerful stuff, people. Here's the Genesis cog setup. Now, stop with your garbage opinions. I don't want your opinion. Just look at what the indicators are. They'll tell you. They're always right, people. Just look at them. 4-hour indicator. What is the RSI? It's 71. Is it going down? No. Is there a divergence? No. Then why are you shorting? Why? You can't short when there's no divergence. It doesn't work. Nada. Here's another one for you. MACD. Where is it above? It's above the 0 line. Okay. Buy signal. Is it above the signal line? Buy signal. Has it curved? Has it curved? Is there a lip curl? Then why are you shorting? Why? Why? I've been telling you for 21 straight trading days, don't short this. I've been right every day. I keep telling you, you're fighting these indicators. It's a bitch. It's hard. You're fighting machines. And when there's less people and they're in synagogue, even more power to the machines because it removes institutional selling. Here's another one for you. The leader line on the Stoke, it just went higher. Buy signal, buy signal, buy signal, buy signal. Congratulations. If you worked for me, I would just fire you. I don't want you shorting. You got to wait. There's a time and the place to short, but you got to wait until October 1st. And when October 1st rolls around, okay, it's a whole different ballgame. I told you last year on March 31st, when April 2nd hits, I told all of you, we're going to get whacked. Bam, I told you. It's the timing. Your timing has to be precise. But the quarter ends are tricky because there's a lot of manipulation in those quarter end reports. Don't mess with the algos. Stop. Institutions. Citadel's not selling. You are. You're not going to make money doing that. Now, here's another thing. Fundamentals. Fundamental catalysts. I call this one Hidden Figures. Remember the movie Hidden Figures? Everybody see that movie? It was a great movie. Here's the fact of the matter. The market's wildly overvalued. We all know that. We know we're in a bubble in every single category except for bonds. Everybody knows it. But because of what Garrett said, and they're just pumping in liquidity, nobody cares. I don't care. Of course you don't care. You don't care until it blows up. Then you care. Here's the thing. The economy itself is not falling apart. But there are areas of weakness. There's areas of concern. There's areas of deterioration. Private credit's one of them. Private credit is facing clear signs of rising stress, says Bank of America. Okay. That was a headline on Bloomberg on this weekend. So the futures opened down 22 because of that headline. Guess what happens? The dippers just come back and rush the market, buy calls, and run it back up because they know it's the end of the quarter and that news doesn't matter. That news in the long run, that will matter. When you start seeing private equity companies blowing up over the place, it'll matter. It doesn't matter now. It doesn't. It will matter eventually, but it doesn't matter now. But that is when people say, well, why did the market sell off? Remember, Bierman told you on September 22nd, this is one of the 100 reasons why you should get out. It's not going down now, but if you ever had a reason, there's your reason. Another two. I love this one. What gives? So the Fed cut its interest rate last Wednesday. We cut it 25 basis points. Big deal. It was already priced in. Markets love rate cuts. So if any of you said, well, the market cut rates and we're going down, clearly you would have failed my finance class. Markets don't go down when rate cuts. When you cut rates, they don't go down. They may not go up very much because they're overbought, but they're not going to go down because it's easy money. It's free money. It's, more money from doing nothing? And they spend it. They go long. But here's a part that Blake Young picked up on that nobody else did. Blake Young's the only guy who picked up on this one. Long-term rates have gone higher, including mortgage rates. So hear this out, people. The Fed funds rate is a short-term, I'm going to educate you. It's a short-term interest rate. It only matters what happens between now and about 2 years out. That's it. But the long-term rate, everything beyond 2 years and beyond, is going higher. What's that telling you? Inflation. Inflation's not coming down. So the message I'm going to kind of disseminate to you is this. The Fed cut interest rates knowing they're going to ruin the economy. The only reason why they cut rates was to kowtow to Wall Street. The Fed is not independent. Garrett's right. They're not. They're in bed with Wall Street. There are. The Fed cut rates deferring to unemployment, which isn't even that bad. And they completely shunned and said, we know inflation's out of control. We know it, but we have one reason to cut, and that's because of unemployment. If you remove the unemployment component and unemployment gotten better and inflation's up, they probably wouldn't have raised rates, but they wouldn't have cut rates. So what the Fed is doing now is it's putting the future risk in jeopardy because we're going to have a blow off top at some point. We're going to correct probably 30 to 40% at some point in the next few years. And when it all happens, it's going to come down to one thing. Everybody's going to point fingers at Powell and the Fed saying, well, why did we cut rates when inflation is still a problem? The answer is because the Fed only thinks in the moment. The Fed is always behind the curve. The Fed has missed the last 20 recessions. They're always behind it. Okay? Blame the Fed for this one. They've over-liquefied the markets. They're just pumping money in. And they just said, oh, inflation's going higher. Let's find a way to cut it to make Wall Street happy and make President Trump happy. And they did. But again, long-term rates never lie. Stock markets lie. Stock markets lie all the time. They just, oh, here's a stock. And then they report and they warn and the stock goes down 30, 40%. Because the chart is just technicals. It's a lagging indicator. The stock market's supposed to be a leading indicator. It's not. The bond market's a much better leading indicator. I trust the bond market. When I see mortgage long-term rates going higher, I know one thing, okay? I don't want to buy bonds right now at this point. I don't. And they're starting to go down again, bonds. And number two is eventually, okay, the inflation will catch up with the market. Last thing I want to throw out today, which to me makes a complete, by the way, the stock market's still going up. How many times did I tell you? Every day I come in here and tell you not to short the market. Every day I'm right. I keep telling you this. I'm not buying it because I can't. My risk reward won't let me do it. But I'm not shorting it either. It's just, you can't win. I know when I can't win. But I am short individual stocks. They are getting crushed and I'm doing well. So I'll stick with that thesis. Clueless is clueless. If you ever thought that the government itself was run by a bunch of airheads, read this headline. The BLS, your Bureau of Labor Statistics, they delayed, okay? The Bureau of Labor Statistics delays consumer expenditures, which was supposed to be reported on Friday because it goes into their model, SIGEX, consumer, consumption, investment, government spending, and exports. It goes into this, it's called SIGEX, CIG plus X. You add them all up, and that comes out to a number. They delayed consumer expenditures with no explanation. Why? They didn't even give a reason. They just said, we're not going to release it, and we don't know why we're not releasing it. Okay, these are the people in charge. Okay, so I'm gonna trickle this down and spell this out to you. Everything that comes out of the government that has to do with finances is just a lie to me. I don't trust any of it. I trust what the earnings of the companies say. I trust what they have to report because of the Sarbanes-Oxley report. Every statistic that comes out of the Fed and the government is just a lie. It's all massaged, it's tweaked, it's coded. We'll eliminate this, we'll add this. All they want to do, okay, is polish a turd. That's all they want to do, even when they know it's bad. They can't even give us the consumer expenditures. Fine, it's delayed. Why? Because we have to go in, we made a mistake. No, we just don't even have an explanation why we're delaying it. And you trust the government, please. All the statistics are a lie. When they unwind all of this facade that they're doing, the emperor's new clothes, and we correct, okay, I remind you, did you trust the government? Don't trust the government. Trust, okay, not even your instincts. Trust what the algos are going to do when reality kicks in. Now, 4 stocks to cover today. We're going to cover Starbucks first. So I called it Morning Jolt. Now, believe it or not, I believe, if I'm not mistaken, there are 60 or 55 different ways to describe coffee. coffee, you know, cup of Joe, Java, liquid crack. There's all kinds of things. But I called it morning jolt because the news came out, okay, this weekend. It came out this weekend, like brand new news. And I told you a million times, I'm not buying Starbucks. Why am I not buying Starbucks? I'm not paying 36 times earnings for a stock growing at 5%. You do it. When it goes to 5, you can send me a love letter. I'm not touching it. I would buy this if it maybe dropped to 50 off a dead cat bounce, but this is egregiously expensive for a stock of this caliber. The law of large numbers tells you that this stock is never going to grow at 35% from now until the end of time. Like literally, there's a joke where Bart Simpson goes into a mall 30 years ago on The Simpsons to get an earring to piss off his, you don't want to piss off his parents. He goes in to get a Starbucks latte, and by the time he comes out with his ear pierced, every single establishment in the mall is a Starbucks. That's how I feel. Starbucks is not a monopoly. It's cannibal. They just cannibalize each other, and there's just no growth anymore. Well, here's the news on Starbucks for all of you liquid crack addicts out there, which I'm not, but I don't, point fingers and I don't, chastise you. Starbucks, okay, says the price of coffee is going to go up, okay, to $7 for a cup of coffee at Starbucks. The price of coffee overall is going up 10% worldwide. Oh, but there's no inflation, Jerome. Mr. Powell, see no evil, hear no evil, speak no evil. There's no inflation. When was the last time any of these government officials actually went to a supermarket and saw that a bag of Cheerios, the small one, is $10 now? And 2 years ago, before COVID, it was $1. Obviously, these people either shop on Instacart or they have their own shoppers, or they're just like kowtow to. They've never actually looked at their shopping bill. People, Starbucks is going to take you through the ringer. All of you crack addicts who go to Starbucks are going to pay $7 for a latte. Okay. That is going to, and then right now, my wife says it's $5. So now they're going to take the price up 40% across the board on Starbucks products. But there's no inflation, none. Starbucks is down today. Okay. And I don't know if that's the news. Starbucks is down because of rotations. I'm just rotating out of, it's just stock rotations. Rotate out of the weak, buy the strong. This is a weak stock, so they're just rotating out. I'm telling you, when this rotation game ends and when they start to go back to the defensive stocks, this is one stock, if I were you, I would not touch this thing. Their volumes are going to fall off. Their margins are going to be higher, but their sales volumes are going to fall off. The question is, what will the stock traders and investors defer to? Will they give the credence to the profit margin or to the sales? For me, the profit margins don't matter as much as the sales. I look at Procter & Gamble, J&J. If the sales are good, I usually buy. The profit margins don't mean as much to me because they can eventually manipulate those profit margins around. This is a situation where if the sales fall, I think it's going to make this stock worse. I think that this CEO who Don picks on, I can't remember his name, I think he's totally screwed. You can't raise prices 40% in an overheated economy or an economy that's already weakening and the consumer's pulling in. Remember, I said that. All right, next on the list here, Berkshire throwaway. Okay, a lot of you do not get this pun. I don't understand that pun. Where is this coming from? Berkshire throwaway. Okay, work with me, TheoTrade members. Come on now, come into my living room. Work with me. Berkshire Hathaway is now Berkshire throwaway. Apparently, before Charlie Munger, who passed away at the ripe old age of 99, passed away, okay, he had convinced the shareholders of Berkshire to go in and buy shares in BYD, which was a Chinese EV maker. Oh, yeah? No me gusta. Not good anymore, people. Apparently, times have changed over here. As it comes out today, here's what the news is. Berkshire Hathaway in August of 2022, at the urgence and suggestion of Charlie Munger, okay, bought basically shares in BYD, but it had purchased the shares a long time before that. That followed a 41% jump in the value of the position. So at one point, they had a $9 billion position in this. By June of last year, Berkshire sold 76% of its stake in BYD. BYD. So let's look at BYD. Okay, they call it Boyd Gaming, but this is like, you can call it before that. So BYD, bring it out here. Okay, now all of a sudden, Berkshire Hathaway, it's a Chinese EV maker. So I think I have probably the wrong symbol here. So I'm going to have to go and look at BYD, see if there's a different one. Is there a BYD? Oh God, there's an electronic. There it goes. BYD electric. Here we go. Okay. They have, I think this is wrong, but I can't, this is having a difficult time picking up the symbol, but apparently, okay, they basically eliminated almost all their stake in the stock. The stock was trading at 225 a share. As of now, they're down to about $54 a share now. So clearly Boyd Electric isn't it, but the symbol itself, if I could find it myself, and I looked this morning, I seem to have lost it, BYD electric vehicle maker. The idea here is this. There was a time where Berkshire bought most of the company. They've almost completely liquidated their entire position. Berkshire has gotten rid of 76% of their shares, and they've completely bailed on the Chinese maker. So I'm just throwing it out there that Berkshire Hathaway has basically said, we're out of the electric car business. I'm thinking like, why didn't Berkshire just buy Tesla? Wouldn't that have been easier? Why did Munger want a Chinese company? I don't know. If I were Munger, I would have just bought Tesla when it's oversold and ridden it. So even Berkshire Hathaway isn't perfect. Next story here. Okay. Core move. There's a pun on the word core, as in Apple core, because we're talking about Apple. So the S&P 500 is no longer the S&P 500. It's the S&P 10. So all you got to do is wake up each day and follow 10 stocks. And of those 10 stocks, 8 of them are technology stocks. So you walk in and all you had to do is pull up Apple. And you're like, Apple's up again? Of course it's up again. It's going to make a new high and rip higher. And if you're short, you're going to get torn asunder. Why is Apple making a new high? They made a core move. And I don't know what took Tim Cook so long. But if you're short Apple, I'd fire you. You were out of my firm. Okay, you can't short this right now. Apple made 2 moves over the weekend. Okay, give Tim Cook some credit. Number one, Apple is now going to produce its own chips. Did you hear what I said? Apple is no longer going to search the market for chips for its own goods. It's going to integrate and develop its own chips, which means its product prices are going to do what? Fall. The price of their margins are going to get higher and their product prices are going to fall, and they're going to actually make more money, okay, believe it or not, on their products because they produce the chips themselves. If I were you and I were short, like I'd be crapping a chimp right now. Look how overbought it is. I don't care how overbought this is. This is a sacred cow. Sacred cows are not sold, and they're not sold at the end of the quarter. So if you bought puts, you're screwed. You might as well close out your position because you're not likely to make any money on this. You never short a sacred cow at the end of the quarter when it's at an all-time high. It is a death knell. Give Gianni DiPocci credit because he loaded the boat on this when everybody hated it. It's good going on his part. The second news on Apple is this, and this is another reason. Apple said, enough is enough. They're in the AI business. Apple is late to the table, but they're going that direction. They're loaded. Go look at how much cash Apple has. Doesn't matter what you think. Look how much cash Apple's got, okay? Just go down here and realize like they're sitting on 31 billion net cash balance. They're going for it, people. They're putting all their energy into AI-driven products, which involves the phone, which involves music. Everything is going AI. They said they're going to have an AI initiative. They're tired of being behind. They're going to play catch up. They're going to start bidding for people. They're going to catch up to Meta. They're going to catch up to Google. I wouldn't doubt them. I wouldn't doubt this company at all. This is a bad short. You don't want to short when the algos are buying. You don't want to short when it's the end of the quarter and all money managers are chasing. You don't want to short when it's parabolic. You don't want to short when you have news like that. You have to be out of your mind. There's a time and a place to short Apple. This is not the time or the place or the price. Would I buy it? I would not. I wouldn't. But if I were short right now, I'd be one worried mother. I would be very, very, very worried. I would be very worried if I were you. If you're short, I think you're absolutely screwed yourself. Last but not least on my list of news today, I call it idle threat, deja vu. Okay, I don't, how do I love thee? How do I hate thee? Let me count the ways, like Shakespeare, because that comes from one of Shakespeare's sonnets. I don't know what it is about the government. They don't like Google. We hate Google. I love Google. Without Google, like, I don't have a job. I mean, I use Google incessantly for information resource. Okay. And it's more than that. Apparently, the US Justice Department, again, how many times is this? 5 or 6 times, is making an attack on what they argue is an illegal monopoly in Google's online search. Google is facing another attempt to dismantle its internet empire in a trial focused on its abusive tactics in digital advertising. Good luck with that. The trial, scheduled to begin Monday, today, is in Alexandria, Virginia, federal court, which will revolve around the harmful conduct that resulted in U.S. District Judge Leonie Brinkema declaring parts of Google's digital advertising technology to be an illegal monopoly. So Google, they're going after Google again, okay? Look how much the market listened. I agree. If I were you, I'd plug my ears. You're telling me you're going to break up Google? They tried to break up Meta, didn't work. They're trying to break up everything. This is not going to work. How are you going to break them up? Is it their fault? You can go to Bing, you can go to DuckDuckGo. Why would theirs be any different? So good luck with that with the US government. I'm not saying it's not going to go down. Eventually, it will correct because the stock itself needs to adjust its multiple. But the idea here is that if you shorted the stock because you thought the government was going to take them down, it's just another idle deja vu threat. The government's been fighting them for years, and they've been losing every time. The government's been fighting Altria for 40, 50 years, and they lose every time. It's a waste of taxpayer money. Let it go, government. Let it go. I don't own Google. I have no vested interest. I'm just like, if you shorted the stock because you took that news, I would fire you. You wouldn't work for me. How is Google going to go down at the end of a quarter when it's its best quarter in history? How? Think, step outside your technicals. They don't work here. They're not going to work until October 1st. Oh, we're up 12. What did I just tell you? What did I tell you? You keep shorting, go and keep losing money. And let me show you what shorting looks like when you have a right. Let me show you what it looks like in the Genesis cog, because most of our shorts are killing it. Want to see a winner? Here's a winner, people. That's what it looks like when it goes down. You can't short on the way up. It doesn't work. You're fighting machines. Get into the Genesis cog. I will teach you. Look at the machines are doing for me. They're making me money. People, that's not me. Those are machines that are pushing it over the edge like Humpty Dumpty. All I did was I identified the correct breakdown, and I identified the correct reason why I'm selling it, because it's expensive. That's all. I just shorted it at 63.65. It rolled down. I took off half this morning. Why? Because I have call spreads and I'm up like 75%. Why the hell wouldn't I take a gain? Okay. I'm just telling you, if you're going to short, okay, hit up the Genesis call. We'll show you how this is done. This is not how you short in the S&P or Google. Those are sacred cows. This is fodder. It's like cannon fodder for me to go out and shoot it whatever I want to. Shorting is our expertise, people. Now, forget what we're talking about today, because the trends, okay, they ain't going to matter. All the technicals. All we're going to do is we're going to pull up the S&P 500 today, new high, and I'm going to keep shorting. Good luck with that one, people. Now, I'm not wasting my time. I have figured out the secret sauce to algos. It's run by algos. That's it. I'm not shorting on the way up. That's the secret sauce. I'll short on the way down, but I got to have a good reason. All right. So here's the S&P going back 20 years monthly. And it looks just like, oh my God. I'll do you one better. I'll go back time frame maximum. We'll go max. I don't know how far this goes back. It might go back to the 50s, probably similar to that. Yeah, I'll do it back to the 50s. All right. So I'm going to drop this on you. I don't know how many days this is going to take. I just don't know, but I can tell you, I'm going to set the record straight. A lot of you think like I don't listen to the other instructors. That couldn't be farther from the truth. I probably listen to the instructors more than, and I never listen to them. I never replay my stuff because I don't want to hear myself talk. I want to know what they're thinking. Garrett, Don, Brandon, Blake, Gianni. I actually listen to them on the bus. I get home. I watch their replays at night. I'm trying to figure out what they're thinking. And what scratched my itch was that Brandon Chapman has been talking about for years about the return on the S&P 500 as it relates to gold and what the true numbers are. And then Blake Young gets into this discussion and he offers his 2 cents. And so for me, it's just like, I'm just trying to understand, like, what are the correct numbers and what are the wrong numbers? So I basically did like, and it's kind of like dumb luck. It's just serendipitous. I go to the internet looking for S&P 500 returns in segmentations. I'm like, okay, I want to look at it for 10 years. I want to look at it for 20 years. I want to be able to curate it. I want to be able to customize it, or at the very least, I want to be able to look at things in a breakdown in terms of how returns really work. And because I'm a professor at Loyola, and I taught it this past week about how the bond market works and how premiums work, I want to get to the truth behind this. So as I'm doing the research, I begin to realize that the numbers that are put out on LinkedIn, social media, S&P, television, okay, advertise, they're all wrong. They're just simply fabricated, because I'm like, there's got to be some more truth behind this. So then I remember the expression by Benjamin Disraeli, "They're lies, damn lies, and statistics," which somehow they gave credit to Mark Twain, Samuel Clemens, which is fine, but it's not. He did say that, but he wasn't the one who basically came up with the idea. He's not the originator. It's actually Benjamin Disraeli. So I went through and I call this discussion number crunch time. So there's a lot of puns here. You have to kind of work with my mind. If you can tolerate me, you can turn me off, whatever. So the idea here is everybody knows what crunch time is. Like, oh, let's give the ball to Michael Jordan, or let's give the ball to, Kevin Durant in basketball because it's crunch time. That's what crunch time is. It's like critical time when the clock is ticking down and you're trying to get the answer or survive something. But this also has a punch in that it's number crunching. There's a number crunching involved here. So I combined the two and I was like, let's get down to the truth and let's do it through numbers, hence number crunch time. And then I kind of just extended this and said, okay, let's get down to the mathematical truth behind S&P 500 returns. You hear stuff all the time. You hear guys on Theo, and we just estimate, we speculate, we hearsay. Okay, screw all that. You want the truth? You want the truth? You can't handle the truth. Well, I'm going to give you the truth. And you know what? I'm going to share it with you so you can do it on your own time. This is what I call a trend category. So again, 11 different categories in my archive. This one falls under the umbrella of trend. It's about returns of trends in markets. Now, to be perfectly fair here and get to the bottom line, so to speak, these are only long. There's no shorting here. No shorting of these returns. So you're like, what was the S&P short returns? There are none. All the data I'm going to provide for you is a long only mathematical formula. That's the first thing you need to know. Long only mathematical formula. The second thing you need to know is inside these returns, there are no commission costs. There are no transaction costs, such as SEC fees or finding fees or things of that nature. So you have to understand, the numbers are raw because I'm taking away everything. So again, there's no, like I said, finder's fees here, SEC fees, no commission fees. There's no taxes. There's no taxes here. Okay, no taxes, no fees, no transaction costs in all these numbers. I'm going to introduce to you, okay, the 3 ways you look at true numbers. You need to do this before you can take a step forward, because I don't really have a timeline on this. I'm not sitting here going, okay, this has to be X length. I'm not thinking that at all. I'm thinking to myself, like, the only thing that matters here is that I reach all of you to get to the truth, because I'm tired of the lies and the spin. Okay, the mainstream media just lies all the time. I want to get to the facts, and the facts are embedded in the numbers. So the numbers are right. The media, put them on a back burner. Let their spin, just like remove their spin, open your mind, tabula rasa. Let me start over, because your brokers, your money managers, they've told you things which are just patently untrue. Okay, so this is the first thing you need to understand about returns. Okay, returns themselves. So there's returns mechanics. You just have to know this. First, they have what's called nominal returns. Okay, nominal returns. Then you have what's called real returns. Then you have what's called dividend-adjusted returns. Okay, so my presumption is, and I'm just thinking out loud, and you can correct me if I'm wrong. I'm just throwing it out there for all of us to, like, in an open forum discussion. My suspicion is a lot of times when these returns are posted by asset managers, broker dealers, benchmark numbers, those numbers, okay, are not dividend adjusted, which means they haven't removed the dividend. They haven't removed it. So it pads the numbers. The next is the numbers they're giving you are what's called nominal returns. People say, well, what's a nominal return? A nominal return means that it's not inflation adjusted. Oh, there it goes. Okay, this is where Brandon Chapman starts to put himself in the pedestal and pantheon of probably to me, the smartest guy maybe with Garrett at Theo. They get it, okay? And I'm not picking on Blake because they're all brilliant, but this like stands above all. Nominal returns are actually what we call real returns plus inflation premiums. Okay? And the thing is, nominal returns, okay, need to remove the inflation premium, because with the inflation premium, it's called overstating. It's called bias. Bias is a term for when people produce numbers, the numbers themselves are skewed by some form of a variable. That variable is an inflation premium. And the inflation premiums over years swing up and swing down. So inflation now is 3%. During 2010 to 2019, it was much more contained, maybe in the 2 to 4%. So it changes every decade. So you have to have what's called inflation adjusted periods. So when you hear people talk about, well, let's hear about the Case-Shiller PE ratio. Well, the Case-Shiller, CASE, okay, CASE is an inflation adjusted, okay, it's an inflation adjusted PE ratio as opposed to just a PE ratio. So the real number is not the nominal number. If you want the real number of the return on the S&P, you have to basically factor in inflation premiums. So the idea here is you have to actually subtract them, but they don't. So real returns are returns without the inflation premium. Or you could take the nominal return, subtract the inflation premium, and get the real return. That's the way you have to do it. So for me, the real return is the nominal return minus the inflation premium, or what the inflation gauge is. That's the truth how to do it. And then you have to take it one step further and go, well, once you get the real return, is the real return factored in with dividends? Because the dividends are compounded. And if they're compounded, the numbers themselves are overstated. In other words, if you remove the dividend and remove the dividend, what is the real return of the S&P? That's again, it's a realistic way of looking at numbers. Because the idea here is you can just go in like the Fed. The Fed does this all the time. They consistently lie. They take a number in a basket of inflation gauges and go, well, we'll remove this and then we'll add this, or we'll underweight this variable and we'll overweight this. Of course you will. You're just going, it's like Don says, you're driving a car looking through the rearview mirror. You're just making it, it's called confirmation bias. You're just trying to make it look the way you want to look it, to soften the number, or in this case, to elevate, or what I call aggregate, to exacerbate and take the number higher. But of course, that's what people do. They take numbers and they add, subtract, multiply, and they curate them to get what they want out of them. Here's my goal in the next 2 to 3 days, 4 days. Let's get out of this. Let's just get out of this crap. Let's go to the actual calculator itself, okay? And let's see how it's kind of really done. So what I did was, and you can call this luck, you can call it God-given. Maybe my dad's in heaven, like standing above me going, I'm going to provide this for you. But there is a website a website. And the website itself is built for everybody. It's free, as in carte blanche. So you have no excuses for this. The website's called ofdollarsandData.com. S&P. So all I did was I scrolled down and I was like, holy crap, they have an S&P 500 calculator. So instead of me sitting down and building a spreadsheet, me sitting down, building an algorithm through my, because I have calculators, I have financial calculators, I'm like, wow, this is as convenient as it gets. Okay, it's beautiful. So it just laid it out, and I was like, okay, I want to see what this is all about. So what this calculator does is, it's not just a simplified calculator. The calculator actually provides, I love this. I was just like a jaw dropping. It made life so easy for me. I couldn't believe it. The calculator, okay, produces the nominal return. So it will produce a price return, and then it will produce a total return with dividends reinvested. Then what it will do is it'll provide an inflation-adjusted return. That's where Brandon Chapman, like, he stands here, he's going to be proud of me to like support him, going, this is the real return. That's the one that matters most, because the fact of the matter is the time value of money is more important than anything. The time value of money is interest rates or the cost of capital or inflation. If inflation is 3%, then your dollar today is not worth $1. Your dollar today is worth 97 cents, because the market always looks 1 year forward. Both the bond and the stock market are worried about what's happening next year and there. Money today is always worth more than money tomorrow. So in order to stay ahead of that game, it's a race. It's a time race against time and cost of capital. That's what finance is all about. So I'm looking at this going, okay, they provide the inflation-adjusted return, price return, and with total return. I'm like, oh, I'm salivating. I'm like, this is awesome. And then it allows you to parse it out. You can go through it and say, well, I want to pick out just 2010 to 2019. And at that point, you're like, okay, why? Because that was one of the best decades, if not the best decade ever. So I did the research, I scanned it, I went through 20 different decades, and the best decade in the history of the markets was 2010 to 2019. Did you know that? A lot of people don't know that. This is not the best decade ever. 2010 was the best decade ever for actually returns in the market. But this one's starting to compete with it. It's actually starting to catch up, and it's got a good 4 years because it's not done yet, obviously. But you can go through and you can pick decades, you can pick years. You just can't pick what's called off years. You can't go like, let's just look at 2010 and 12 and then look at 2025 and 24. You can't do that. It has to be a straight line segmentation of a representative sample set. So you could pick 2020 to 25. You could pick 2010 to 2025. You could go all, and it goes all the way back to 1871. Okay, so this like puts a whole different spin on everything. And if you're going to give me this argument like, well, who cares what happened in 1871? It's a different world now. That's a cop-out. Of course it matters, because inflation was different then. The markets were actually much more volatile then, right? The bid-offer spreads were wider. It was even crazier then. It was much more realistic than now, where it's tempo controlled by machines. But even back then, there's phenomenal decades and there's terrible decades, just like there is now. Like the decade of 2000 to 2009 is the lost decade, which I'll show you tomorrow. But I just want to like, this provides everything. So I walk through and I'm like, we can look at the best decades. We can look at we're going to look at them all. I want to like show you, like, you can't trust everything people on TV show you. Now, I'm not trying to sell you anything. I'm not trying to sell you a product. I'm not. I'm just trying to tell you, like, let's get the numbers right so we really understand how good the markets are really doing. Because if you're looking at a chart going vertical, you're not factoring in dividends. You're not factoring in inflation at all. And you're not looking at like the idea that, there's a time when there's going to be like mean reversion to bring it back into alignment. So I'm just going to keep it short and sweet today and show you, like, I'm going to bring this up for you right now. If you scroll down, okay, you get this calculator right here. So I'm going to take my lighting down here and show you. Like, this is a calculator, okay? Rob Schiller's website does not count for fees. And I looked at this and I'm like, okay, you get a starting month. So I'm going to start August 2015 to August 2012. I'm just going to look at the last 10 years from August to August. 10 years, 12 months, 120 data points, right? And here you can pick on any month you want and any ending month you want. So you realize today is the 22nd of September. So you can't really say use today because it won't fully grasp it. It goes by month. It doesn't go by day. It goes by month. So you got to be careful that when you bring this data out, you're like, well, let's compute the data on the 15th. Well, you're missing 15 days this month. You have to use the prior month, that's the closed, and month that's been fully materialized to make sure it works. The idea is you can put down as much money as you want. You could put down a $10,000 investment. You could put down $1,000, however much you want to put in here. I think 10,000 is fine. And then you click on this. And again, it doesn't account for taxes, fees, or transaction costs. Okay. So you're getting the rawest number without, because, you know, transaction costs are different per broker. How are you going to pull that all together and conflate that? You can't. They're all different for fees. You can't bring that into play because it's different for every broker and different for every time period. And you can't bring in taxes because that's different for federal periods and different for states. All of these numbers cannot be in the model. And that's even better. So you can't skew the numbers and you can make the number come out smooth and raw. That's just what I want. So I looked at this and said, all right, I'm just going to calculate it for the last 10 years and see what's happened in this market, where algorithms now basically, the last 10 years, 90% of the market is all algo. It's all algo, people. It ain't you. It ain't your money managers. It's just all algos running the market and money managers piling in to the S&P 20. That's it. All ETFs, like Garrett said, they all own the same stock. Let's own Walmart, JP Morgan, Tesla. That's all they own. They literally own 10 stocks and the others don't even matter at this point. So let's just see what the returns are. Scrolling down. So the nominal price return over the last decade, during which we had Trump, we had Biden. It's the leaving out on Obama for 2, Trump for 4, Biden for 4, and now a year into Trump. So it's 1, 4, 1, 4, 4, 1, right? That's the nominal return. That doesn't factor out inflation. It doesn't adjust for, okay? It's not correct, okay? Look at the annualized return. So again, I'm not picking on Don. He comes on this morning and he says, look, the average return for the S&P has been 10%. You need to contextualize that. It's not 10%. What decade are you looking at? That's the key. Are you looking at the last 100 years? Are you looking at the last 5 years? Like, state your case. What is your time duration? Because that will define the veracity of your statement. 10% is not true. The last 10 years has seen a 12.1% gain in the market, absent of, okay, remember, transaction fees don't count, taxes don't count, commission costs don't count. So your investment grew from 10,000 to 31,418.42. So if you put in $1 million in the S&P in 2015, it would have grown to $3.1 million, assuming you didn't pay any taxes, assuming you bought and held, but you never traded it. You can't trade it. If you trade it, that number means nothing. This is a buy and hold thesis, people. You bought it, you held it, and you never sold it. You're holding it straight through 10 years. That's your holding period, 10 years. No trading, buy and hold. Remember that, because if you didn't, you're just lying to me, okay? You have to buy and hold through those 10 years. Now, let's look at the nominal total return. What is the nominal total return? That's the return with dividends invested, and not only in the dividends collected, but they're reinvested and rolled over from year to year to year. So it creates this, time value exponential, exponent gains. Okay, it's compounded gains in cash flow. That's cash flow. That's principal. And that's principal plus cash flow. Okay, so the nominal return with dividends is 272.77% over 10 years. Everybody clear on this? Great. Now, look at the difference. Dividends provided an additional 68% or about a 58% return, an extra 58%. So almost 25% or 20% of that gain thereabouts is ascribed or associated with dividends. That's how you do it. It's like, oh my God, I made I made 10% per year, but the other 2% is, added on top of that is what? Dividends. Look at the annualized growth rate. Now, your annualized growth rate has now gone from 12% to 14%. So the dividends, you realize, provided an additional bump of about 2%. That's the S&P 500 dividends. It gives you it's an annualized return of 2%. So if you said to me, okay, the last 10 years, I made 14% of the S&P, technically that's true. If you basically reinvested your dividends and never took them out or paid tax on them. Okay, so it has to be in a tax-free account or that this doesn't hold because you're taxed on your dividends in a non-tax shielded account. Then you could use the argument saying, well, more realistically, okay, the price return was 12%. That I will buy into. Now, work with me. This is the part that kind of brings reality home. All right. So you tell me, okay, I ask you, well, what's the inflation adjusted return? That is my concern. My concern is, well, those are numbers, but they're not really inflation adjusted. If you factor in inflation, and inflation itself is the time value of money that is an exponential compounded interest function, just like dividends are, this is your actual return. This is what Brandon Chapman's been getting out for the last 3 years on Theo. This is what he's talking about. Your inflation adjusted price return is actually 131%. Did you see that? Your return is almost 100% below your nominal price return over 10 years because you factored in inflation. Now, look at the annualized return. It's still awesome. Don't say it sucks because it's awesome. It's 8.76% over the last 10 years. Well, how many down years have there been in the market in those 10 years? I think 2. So 8 up years, 2 down years. If you bought the S&P 10 years ago till August of this year and never traded out, okay, and this doesn't include dividends and just left it, your actual return on your money is 8.76%, which is really impressive. But keep in mind, the best decade in history is 2010 to 2019. This is just an overlap. You starting to see where I'm going with this? Because when you get out of the 2010, 2025, that spectrum, your returns just utterly stink. The Fed has made all of us rich. None of us have done anything for the credit. You remove 15 years, you're going to begin to see holy crap, I haven't really made any money. You haven't made any money at all. The market is being manipulated by the Fed by pumping in money because the real returns with inflation erode almost all the value of your stock. Did you realize that? Now you're beginning to see where I'm going with this. The investment grew to $23,160, which is really impressive. It's like, oh, I put in $10,000 in an S&P fund, and 10 years later, it's $23,000. That's good. I put in $1 million. Your $1 million is worth $2.3 million. What's to sneeze up? It's not a bad thing. You're rich. You're filthy rich. But move down a little bit lower. Here's your inflation adjusted return. Your inflation adjusted return with dividends is going to pop because the dividends in the price return weren't factored in. Your inflation adjusted return was 175%, which bumps it up 45%. So you have an extra 45% return just on the cash flow provided by the dividends that are given to you and disseminated to you through the S&P 500 index that are paid out to you. Okay, that 2%, look at it. What now is your annualized return? It's 10.65. So once again, you're getting that bump of almost, but not quite 2% because of your cash flowing through dividends. But here's the key. It's inflation adjusted. They're taking the cash flows, they're taking the price, and they're discounting every single year, one at a time. So they're discounting 1 year with an inflation to the one power. This next year they're discounting all the cash flows going back 10 years from where we are today to 2015. That's the part that you guys are not seeing. It's not about today. This is not what it's worth today. This is what it's worth 10 years ago, where it is today, 10 years ago, because that's making an assumption that it's adjusting for all dividends and what it's really worth. So basically what it's telling you is, okay, inflation adjusted, that $10,000 you invested 10 years ago, okay, with inflation, you're up $17,504. You're still way ahead. You're still above inflation. You are. But don't tell me like my returns in the last 10 years is 25% and I bought the S&P. Whatever manager said that to you is just simply fab. He's lying. That's not what it is. I told you what it is. Your nominal return, okay, is 12.13%. Your dividend adjusted return, reinvested, is 14%. Okay, that's the last 10 years. It's impressive as hell. I'm not denigrating it. I'm just telling you the real number is this one right here, 10.65%. You're ahead of inflation. You are comfortably ahead of inflation. But don't tell me like you're up 20 or 30%. Your managers are basically showing these figures, 25, 30% returns, but they're not inflation adjusting them. And they're not adjusting them properly for dividends and showing you with and without dividends. That's the true way to do it. That's the way you should do it. Now, GIPS is Global Investment Performance Standards. GIPS does not make Global Investment Performance Standards. GIPS does not make them inflation adjusted. They don't have to inflation adjust it. But I'm just telling you, if GIPS automatically integrates inflation adjustment into it, every return of every manager is going to be cut down by a third or in half. Now come back tomorrow, because when you come back tomorrow, we're going to talk about, okay, specific periods of time. We're going to actually curate it. I'm going to walk you through calendar year returns. I'm going to walk you through 871, best decade, worst. I'm going to cut and splice this thing in pieces and show you, like, if you held money from here to here, you lost a ton of money, plus you got eaten alive by inflation. And then you're going to realize, like, once this market corrects, and if it corrects 40%, it'll be a lost 30 years for all of you. Every one of you, like, what if it corrects to 33,000? You'll have lost literally 30 years. You'll have a negative return after 10 years. Negative! Because you'll adjust the inflation factor in there. You're like, wow. That's why I keep telling you, at some point, you got to get out of this. Because if you're long this and it gets cut in half, it will destroy the time value of your returns. And then you have to spend another 10 years trying to make it up. Yeah. This is what I'm trying to teach you on trends. In the meantime, I'm going to turn this over to Gianni DePoci. And as I said, Gianni, what have I said every day for a month, Gianni, about shorting this market? What do I say every day when it goes down? Is it shortable?
No, it's generational buying opportunity.
No, it's not, but it's not shortable. It's just not shortable. Gianni, it's just, you can't short a market at the end of a quarter.
No, especially with tech leading to the upside. Tech's still leading, so good luck.
I don't care tech or not. You can't short a market that looks like it. What money manager?
I won't short a market with tech leading.
Name one manager in the world that's going to sell this market who owns the S&P.
I'm sure there's some dude on CNBC saying it. Yeah, I'm sure.
Well, maybe on October 1st.
Yeah.
But not now. Okay. So I'm just sitting here and I'm riding it down on the short side pretty well. But I know for sure at some point that the shorts that I'm short I'm gonna have to cover those because they're gonna be the winners when they reverse. So I don't take it for granted at all. But
I really like how you said, when this market does have that pullback, be ready for a lost decade in stocks. I mean, it's happened multiple times throughout history. It doesn't really take a rocket scientist to figure that out. I mean, you look at the NASDAQ's recovery after the dot-com bubble burst, 15 years it took for the NASDAQ to hit a new all-time high.
Yeah. I don't know if it's going to take 15 years because of the liquidity and the way the robots work nowadays. But when I don't think it's going to go down rapidly, Gianni. I think it's going to be a slow bleed. Like, because the algos defend volatility. They keep volatility intact. But I think like it'll be so hypnotic that at some point, once it starts its way down and breaks underneath some key level, maybe the level's 5,000, I think it's going to accelerate so fast that there'll be no time to react for this. And at that point, it'll be a generational buying opportunity. That's my
No, I disagree. Every day that we have a pullback is a generational buying opportunity.
All right. Well, you just
I'm joking. It's a joke. It's a running joke. Come on, we've had this going for like months now.
I know, and it's eating Don alive. It's just Don is just getting eviscerated on this every day. So I'll leave it to the two of you to go through and have some fun. I gotta jump. Have a great day. See you later, Blake.
Thanks. Hey, see ya.
All right.
Hey, Gianni.
Good morning, Blake. How are you?
I'm good.
What's it like being another day in the life of Mr. 10%?
3 winners, 1 small loser. So we're doing good today.
Okay. Well, I'm looking forward to it. I actually have currencies up to start the